Hi again. In the first video, we discussed long-term notes payable. Let's carry on with another type of debt financing called bonds payable. Why might a company issue bonds rather than notes payable? Bonds are used to fund really large projects that demand a lot of money, more money than a single lender or a consortium of lenders can provide. Nations, states, cities, school districts, and companies, of course, all issue bonds. Certain types of bonds can offer very favorable interest rates, including the California Economic Development Corporation bonds. The state of California issues bonds for many projects, such as the high-speed train that is to be built through California's Central Valley to connect Northern and Southern California. A bond issue consists of a number of bonds that are sold to many different investors who are also called bondholders. These are the people who lend the money. Many times the bonds are traded just like stocks and may have many different owners before they mature. Since bonds are bought and sold in the market, they also have a market value or a price which may be higher or lower than their par or stated value. Because billions of dollars are raised each year in bond sales to the public, bond issuances are regulated by state and federal laws. The bond agreement is a legal contract between the issuer and the bondholders. A bond may also receive a bond certificate as evidence of the company's liability. A bond certificate, such as that shown in this slide, includes specifics such as the issuer's name, the par value, the contract interest rate, and the maturity date, and how frequently interest is paid. Many companies reduce their costs by not issuing paper certificates to bondholders. Companies that issue bonds make two types of payments to the bondholders. This is important. They make periodic payments, which are for interest, and they make a big lump sum payment for the bond's par value, which must be paid on the maturity date. We'll look at these payments in more detail in a later section. Why would a company issue bonds rather than sell stock? Well, there are several advantages for issuing bonds instead of stock. Companies issue bonds because it's a way to raise needed capital without sacrificing ownership in the company. Selling stock in our company forces us to give up part of our ownership. Another advantage of bonds is that interest on bonds is tax deductible, thereby reducing the actual taxes paid by the company. Now, on the other hand, there are some disadvantages to bonds. The biggest one is that we have to pay back the money we borrowed, plus interest. These required cash payments may be difficult if a company has tight cash flow. Equity financing, in contrast, does not require any payments because cash withdrawals, as are called dividends, are paid at the discretion of the owner or the board of the company. When issuing bonds, it's important that the borrowed funds are used in a project or an expansion that will have a higher return than the interest expense that's paid on the bonds. We call this positive leverage. In short, bonds are debt, and I'm not going to cover the details of all the types of bonds in this lecture, but if you'd like to learn more about them, please review your textbook, as well as the tons of information on the internet. I will not hold you responsible for knowing the definitions of the different types of bonds. Now, on the bond issue date, the bondholders give the company the market value or the selling price of the bond, and the company gives the bondholders a bond certificate. At regularly scheduled dates during the life of the bond, the company pays the bondholders interest. Our textbook examples generally pay interest twice per year. Interest is calculated as the bond par or face value times the contract interest rate on the bond times the length of time the bond has been outstanding during the year. Just like all interest rates, the contract interest rate is expressed on an annual basis. At the maturity date, the company pays the bondholders the bond's par value. Now let's see how to account for a bond issue. We'll continue with a couple concepts first, then look at an example of bonds issued at par or their face value. Par value is the face value or the principal amount of the bond. Picture the fancy document printed to include the par value, a stated interest rate, and maturity date. Now, often the interest rate printed on the bond may be different than what is being reflected in the bond market. As you know, interest rates change on a daily basis, depending on what the company is up to, events in the global economy, what China is up to, how Europe is doing, and our own national mood. Issuing a bond at par value means we get the full amount of the bond's stated value, not a penny more, not a penny less. In other words, we get the entire amount of the bond in cash that we will have to pay back at maturity. It also means that the interest rate stated on the bond, this is also called the contract rate, is equal to the market rate. Again, the market rate is the prevailing rate of interest of all other similar bonds sold on the same day that our bond is issued. In this case, we debit cash for the par value of the bond and credit bonds payable. Easy peasy, right? Let's look at King Company. You might want to just jot down the following facts on a piece of scratch paper while pausing the video. In our example, King Company issues bonds at par value, and King's bonds have a par value of $1 million, a stated interest rate of 10%, with interest payable on June 30th and December 31st. The bonds are dated January 1st, 2013, and they mature 20 years later on December 31st, 2032. On the issue date, King would debit cash and credit bonds payable for $1 million. The bonds payable account is always credited for the par or the maturity value of the bonds. Okay, that's important too. Now, every 6 months, King makes a payment for the interest calculated at the stated or the contract interest rate. And on the first interest payment date, King writes checks to the bondholders and records those checks with a debit to bond interest expense and a credit to cash for $50,000. The interest is calculated as par value times stated rate times months outstanding. King will actually make this entry every 6 months until the maturity date. The cost of borrowing $1 million then is $50,000 every 6 months. A bond's maturity date is its due date, when the bondholders will be paid in full. On the bond's maturity date, King will repay the bondholders for the par value of the bond and get the liability off the books. King will debit bonds payable and credit cash for $1 million. At this time, the debt is paid off, or as accountants call it, extinguished. This seems pretty straightforward, right? Things get a little more complicated when the market rate of interest is different than the stated rate of interest. We'll talk about that next when we look at discounts and premiums on bonds payable.